Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending November 22nd, 2019. So this is a weekly chart of the S&P. You can see that it ended down for the first time in 6 weeks. And here it is on a daily chart. So here's Monday, here's Friday. And the major averages ended down between 1/3% to 0.5%, which is not very much. And you can see the candles here. So it's kind of a dip, kind of like almost hammer candles, like this one here on Wednesday. So basically prices come down from the open and then kind of rally up a little bit in the afternoon into the close like you saw over here and over here. So it's really just a correction. If I was a bull and I owned this market, I wouldn't be concerned about a 0.5% pullback. Actually, I'd be relieved. But price action recently has actually been kind of telling, not the least of which has been small caps, or IWM here, trading basically in this rectangle range. And I touched on this in last week's video, that this was the same kind of price action that was going on back here in July at this high, and kind of shook out below and then above and then kind of came down. Now, as I touched on last video, it's been pretty much this whole phase one trade deal from back here that's been driving all this. So specifically last week was this comment by Larry Kudlow in the very early evening session when volume is just the thinnest it can possibly be, that the mood music was good from the trade negotiations, and that kept the market up on Friday last week. And then on this 15-minute chart, this is Monday through Friday over here, and you can see this price action is getting a little bit on the bearish side. Here's the week on a 1-minute chart, the S&P in the green and red candlesticks, and the white line here is my most shorted index, all the stocks that are most heavily shorted. So you can see a squeeze over here on the open Tuesday, and we got a little squeeze Friday on the open, and then also Friday afternoon. But this over here, this last week, is nothing compared to the short squeezes that we saw in October and into early November. Just huge, massive short squeezes. So my take on this is that this run probably run out most of the shorts. And make no mistake about it, these short squeezes have been a big part of driving this rally. So they're kind of falling off over here. S&P sector performance was a little bit more revealing, and especially the price action. It's very similar to the broader index, the S&P 500. But for the moment, sectors 4 of 11 closed green for the week. The rest of them were red. The only really notable leader was healthcare again. It was up 0.8% for the week. And financials closed up about 0.6%, utilities 0.25%, and communications 0.1%. Bonds acted pretty well this week, up 1.5%. On the weak side, this was what was kind of revealing. There's been this idea that the trade deal is going to solve all the problems of the economy globally and in the U.S., which is slowing. And over the last, 6 weeks maybe, there's been this rotation between the value sectors and the momentum sectors, and from defensive sectors like utilities or real estate or staples to the cyclical sectors, the growth sensitive sectors. Relative weakness was seen in some of the more sensitive sectors or subsectors that lead the main S&P sectors. So semiconductors down 3%, retail down 2.25%, and transports down. So the takeaway on the week as far as sectors go were that the cyclical sectors that everybody's been rotating into on these trade deal hopes were the worst performing on the week. So here's a 30-minute chart of the S&P 500, and what I've been saying in all my videos the last, 5-6 weeks is that price action has been bullish. It's been the bulls in control, as you can see up here, this trend. This is that phase one trade deal rally trend from early October. I generally use, I guess about 4 different things that I look at as far as analysis. So one is always price action, and that's the most important. Indicators, I don't use a lot of indicators, as you can see, but I do use them. So like 3C, market breadth, participation, internal, stuff like that. And finally, market signals. So that would be, okay, here's what equities are doing. What is the bond market doing? What is copper doing? What is gold doing? What are currencies doing? So these all are kind of indicators of what we can expect from price, but price is king. If you've been following the last 3-4 weeks of videos, then you probably know there are a lot of red flags out there that's not showing up in price because there's this optimism over the trade deal that's just bidding price higher, but there are a lot of red flags. So while the S&P was only down about 1/3% for the week, it is the price action that got a little bit more bearish on the bearish side. This is the week on a 5-minute chart for the S&P. So you can see open Monday, came in Tuesday, Wednesday, and we had this decline. And the rest of the week from basically Wednesday morning over here until Friday was this kind of bearish flag right along this major trend line that defines the phase one trade deal. And what's interesting about price is what you observe on the micro level, you can observe on the macro level. So you can see this kind of down and almost like a bear flag. It's not quite a bear flag, but down and then consolidating against the preceding trend, which was down. So an upward slanting flag in a consolidation. And you can see that on a micro level here Tuesday. So drop and then kind of this little flag action that led into Wednesday's decline. This is what I would call a change in character in price action. And this is observable the last couple of weeks in S&P sectors. This is very reminiscent of what happened in September at the September high. Here's that September rally, and you can see a bull flag right here stopping at resistance at 30.20. Here's the Dow or the diamonds, the ETF for the Dow, same thing, a breakout above this range, a bullish consolidation, a bullish rally, then a bullish flag. And then there was a transition in price. So I'll show you that on a 15-minute chart. So here's that bullish flag, resistance, another small bullish flag, and then another small bullish flag. These are kind of trying to launch and failing at this resistance 30.20. And then look how quickly price turns to more bearish consolidations like bearish flag, bearish flag, bearish flag. And initially when that happened, these were very small declines in price. It wasn't anything anybody was worried about. And you can see the flags, the bearish flags getting bigger and bigger. And then we'll just walk this through to see what happened next. Kind of break down and sell off. But the point is the transition from very bullish price action to increasingly more bearish price action. And that's basically what happened this week. Here's this 5-minute chart of the S&P 500 this week, turning from, bullish consolidations to a more bearish consolidation, but trending right along that major trend line, phase one trade deal trend line. So let's go back to the S&P sectors I was talking about. I'm going to change this chart, and I've backed this up to the start of the previous week or the end of the previous week. So this is materials. Again, bullish consolidation, ascending triangle. The industrial sector, bullish flag. This is kind of an ascending triangle, almost a little bit more of a rectangle range, but it broke out above that the previous Friday. The technology sector, a small rectangle here, which is fine. It's not big like IWMs, and an uptrend broke out above that. Semiconductors, another bullish ascending triangle. So that's a zone of resistance, but the demand is increasing because we see higher lows. But as we saw a lot of these kind of bullish consolidations, and there were some mixed signals. Here is the energy sector, again, backed up before the start of last week. It has a bearish descending triangle. Now, I give it the benefit of the doubt because the preceding trend was up, but this is a bearish consolidation. The financial sector, same thing, a bearish descending triangle. So there is support down here, but it is making lower highs, lower highs. The bulls aren't able to make those higher lows or higher highs. Then you have the regional banks, which are actually leading the financial sector lower in this channel. And the same thing for Dow Transports, leading the industrial sector down in this channel. So even though the industrial sector was consolidating bullishly, the sectors or the subsectors that tend to lead the major sectors were not acting as well, trending down. It's still just a consolidation pullback, but there's a change in character and tone, and specifically like the regional banks in the most sensitive or higher beta areas that tend to lead. So let's go back and take a look at what these sectors did this past week. So here's materials. This is bearish. So breaking down below this trend line that's represented that phase one trade deal uptrend and in a bearish kind of flag. Here's the industrial sector. Remember, ascending triangle, same thing. It breaks below the consolidation. This is a very kind of bearish flag, but it's still above this uptrend. The price action has just morphed into more bearish kind of price action. The transports that tend to be more growth sensitive or lead industrials just extended this decline. So this is no longer a bullish flag. And this is kind of what we saw again in September, especially with like regional banks. They kind of started off as a bullish flag and then just continued to come down. So this is no longer a bullish flag. It's a decline in transports. Here's the technology sector. They break this little uptrend. And this is not a bearish flag. A bearish flag would consolidate upward against this preceding trend of the downside move. This is kind of drooping downward. Here's semiconductors. Again, another attempt to break out that failed. So from failed moves, you tend to get fast reversals down through the consolidation. kind of leaning towards a bear flag, but it's just bearish price action right here this last week. The energy sector broke down below early in the week, bounced back up with a big spike in crude on OPEC headlines, but you can see again, bearish consolidation descending triangle failed, and this is support, as you can see going back several weeks over here. And then there are a few sectors that are still holding up well, so communications, this is kind of, it's not a true bull flag, but is similar to a bull flag, and the measured move over here, it reached and it's kind of just consolidating. And the other one is healthcare that's doing really well. So this was a bullish ascending triangle, broke out, met the measured move, and is still doing pretty well. But a lot of other sectors that we'd seen that had bullish ascending triangles have failed, or some of the other ones that had bearish descending triangles also broke down. So you have basically about 2 sectors that are doing pretty good. And then interestingly, considering that everybody has been rotating out of defensive and into the cyclicals, or out of momentum and into the value sectors, we have consumer staples. And let me just back this chart up a little bit more so you can see. So as all that's been going on during this phase 1 trade deal, this sector has been moving sideways in this big rectangle range. And here's its uptrend from 2019. So not just recently, but the entire year. And it's sitting right here at the top of this consolidation, ready to break out if things turn south with the trade deal, or if the economy turns even further south. And we'll get to that in a minute. As I mentioned before, there's been a lot of red flags, and that includes breadth and internals. So S&P has been holding this uptrend, so that's really what matters most. But the point of indicators is to either confirm the price strength or to diverge from it. And sometimes they diverge from it for a while, but that's the point of indicators. Their job is to tell you what the probabilities are that this trend continues or that things are going wrong. So in market breadth, this has been a real issue this entire rally and just gotten worse. Here's a quick example. This is the NASDAQ composite in green on a 15-minute chart. So you can see the June, July rally, the September rally, and this most recent one. And in white, we have the NASDAQ composites advanced decline line. It's usually not a very sensitive indicator that's going to tell you that, something's wrong in breadth. As you can see over here and over here, it's kind of moving with price. But the last several weeks, look what it's doing over here. You have fewer and fewer stocks participating in this rally, not only in the NASDAQ composite, which is basically all the NASDAQ listed stocks, but the NYSE as well. Here's the S&P 500 in green, and in white, this is the percentage of all NYSE stocks that are trading above their 40-day moving average. Again, this one is a little bit more sensitive. You can see breadth divergences like back here in July. The indicator's not making a higher high. There's fewer stocks participating in the rally. Over here in September is actually pretty strong. But look what has gone on in this rally. It has been horrible for 1, 2, 3, 4, about 5 weeks. And now I'm going to show you one that has more to do with volatility than it really does the S&P 500, but it still tells us something about that. So still the S&P 500, this is the absolute breadth index. You can see kind of drooped over here into the July rally before the sell-off. It was pretty strong over here in September. But again, I think it's more useful in terms of predicting or getting an insight into what volatility could do. So let me change this to volatility. Okay, so we have the VIX up here in green, and we have the absolute breadth index down here in white. And what happens is when this makes really extreme lows, generally under 20, you tend to see spikes in volatility. So there's a low over here. Here's a low a few weeks later, spike in volatility. Same thing back here. As a matter of fact, let me create a condition real quick so we can see when this is at a pretty extreme low. Okay, so here they are painted under 14, which I consider an extreme low. This one, not a great signal, but about a month later, you get a pretty good move in volatility. Over here, good move in volatility. Over here, good move in volatility. Over here, again. Over here, same thing. Over here, same thing. In generally about a month, and that's what we're getting over here. But this is the lowest of the year, as you can see over there. And in fact, lowest signal really in a lot of years. And this is indicative of what you see before you get these big volatility events, usually a couple weeks to maybe a month. And most of the moves are at least 20% in VIX, some well over 100%. Remember that volatility and the S&P 500 or the stock market tend to move inversely. So when you get these big moves in volatility, you get big moves down in the S&P 500. This indicator is telling us we're in the zone where we should be expecting a big move probably in the next week to a month, I would say. But the overall takeaway is that as the market's been advancing, there have been fewer and fewer stocks, sectors participating down to levels really that you typically only see when the market's pulled back 3-4%, not just off all-time record highs. Now let's jump to bond yields, because this is one of the more interesting things that happened this week. So here's the takeaway. The 10-year yield lost another 6 basis points this week, 10 basis points last week. That's down 16 basis points over the last 2 weeks. So what this is reflecting is more uncertainty. Treasuries are tracking in lockstep with the dollar-yuan pair, which reflects trade optimism. So here's that trade optimism. Actually, let's start back here. Consolidation, weren't sure which way this was going to go. A breakout that failed after the FOMC. This big move was trade optimism, so it's retraced all of that in the last 2 weeks. The 30-year yield lost 8 basis points, a little bit more than the 10-year, and over the last 2 weeks it's lost 20 basis points, which reflects curve flattening and economic growth slowdown concern. In fact, we can pretty much pinpoint when. November 8th, okay, that's when this decline in yield starts. Jumping over to the commodity currency pair, the Australian dollar versus the US dollar, my members know that I track this very closely for risk on, risk off. This has been risk on. So when did this start turning down? Right here, November 8th, and it is down into the red alert zone. I send out these color-coded charts, up here is risk on, down here is risk off. So currencies and bonds are reflecting the same thing. They've gone more risk off, more concerned about the economic outlook, less optimistic about this trade deal. So coming back to the 10-year yield, it's basically retraced most of that trade optimism, and we're seeing currencies doing the same thing. The 2-week plunge of 16 basis points here, 20 basis points in the 30-year yield, that is yield curve flattening, and that was one of the more notable aspects of this past week. This is the S&P 500 in the candlestick, so this is the July rally and decline into August, September. This is the trade deal optimism, and this is the 5-year, 30-year yield curve in white. So now if we take a closer look, here's the yield curve steepening, leading higher into the phase 1 trade deal. I think it was announced right there. And over the last week, this has been a really spectacular plunge. Here's what it looks like on a 1-minute chart. So this is basically the last week. So first, yields declined, and now yield curves are flattening. Now, typically, a flattening yield curve or any change in direction, like a sharp advance, like we saw before, a sharp steepening or a sharp flattening, tends to lead the financial sector, and that tends to happen first in the more sensitive regional banks. So here are regional banks. Remember I said they've been declining over the last several weeks in this kind of narrow channel. They've been following this yield curve. And as we just saw in the S&P chart, that tends to also lead the S&P 500. The market maybe got a little bit ahead of itself in expecting a recession back here in August, and probably got a little bit ahead of itself over here, expecting that a trade one phase deal would save everything economically speaking. And remember, it's only beans for tariffs. It's not the really contentious issues. So this past week, this was one of the biggest developments, the yield curves flattening. So the bond market is saying, we don't buy this. What stocks are buying hasn't been extremely enthusiastic about it, but this last week really is saying it doesn't buy it. And that's the same message we're getting from the currency market. Touch on a couple commodities real quick. This is USO or crude oil. So it's been trending actually in a broadening formation, a right angle broadening formation. Back here, it started to show up in the major averages and then kind of went away the next week. So there was evidence of these broadening formations, which is basically chaos. This is about the 58 level for WTI crude. This week it extended it by making a lower low and kind of broke out above it. But the thing is, this is a right angle broadening formation. They're typically higher highs and lower lows, so more like a megaphone. That may be what's going on here. I don't know yet. I don't have a strong conviction on crude either way. I think the Fed pumping all this liquidity into the market reflates assets, not because of growth, but because of the fact they're pumping so much money in. And usually commodities, especially crude, benefit from that. But I'm not quite sure yet whether this is going to be a broadening formation, which, as you know, is not a good thing, or whether we're starting to see a breakout here. So we'll take a look at that again next week. And UNG, or natural gas, hanging in there pretty good. Last week I talked about this inverse head and shoulders, left shoulder, head, right shoulder. It's turning a little bit more complex. And taking a closer look at this week, here's the head, here's the right shoulder. This is a pullback from the neckline, which is fine. Volume still looks good. I just didn't want to see it break below this right shoulder, and it didn't. This larger inverse left shoulder, head, right shoulder, and neckline, inverse head and shoulders. So overall on the week, the takeaway is that price action has gotten a little bit more bearish, and we can see a microcosm of that here and then on the macro here. But the main takeaway is that we have not really violated this uptrend line, just consolidated right along it in this kind of little bearish type of price action. It's not quite a bear flag. It just leans towards a more bearish tone. And we can see that in the transition from S&P sectors going from bullish consolidations to either failed or bearish consolidations and then breaking them over here, semiconductors. Now the red flags that I've covered the last pretty much month, there's been more and more and more. So high yield credit, leveraged loans looking really risk off, looking actually very dangerous. The VIX correlation. And speaking of that, VVIX, the volatility of VIX, like VIX, which has been showing relative strength and trending up for 1, 2, 3, 4 weeks, hit up here at 99. So this is kind of like a level where you expect price action to not be so low volatility as we've seen for the last 5 or 6 weeks, but increasing volatility. So on the news, expect to see bigger swings up, bigger swings down, because this volatility is getting higher. VVIX is getting up towards 100. When it gets into the 110 to 115 area, that's like put on your crash helmet. Things are going to get serious real fast. To me, this is the biggest red flag out there. The S&P 500's rally from the trade deal optimism trade deal phase 1 announced there. And this is high yield credit in a light blue over here. So I've been talking about this for 3-4 weeks, and I've been showing this pretty much every day. This is a massive divergence. Usually it will diverge over here for a day or so before prices follow. This has been going on for 4 weeks, and I've been alerting everybody about it, especially my members. Every morning we're looking at this, every day we're looking at this. And now over the last week or 10 days or so, you're starting to see articles everywhere, Wall Street Journal, Bloomberg, all talking about what the hell is going on with high yield credit. It's not just high yield credit or junk credit. It's also being seen in leveraged loans, other places. So the takeaway on that is, if the economy slows and the market pulls back or even sells off, that's just a function of the economic cycle. That's normal. It happens. But when you get a lockup or a freeze in liquidity, in credit, that is when it goes from like a slowdown or a recession to like game over fast. And that's what we saw in 2007, 2008, the financial crisis, was that liquidity just froze up. And quite frankly, I believe that's why the Fed reversed everything that they were going to do, hiking rates this year to cutting rates in early January, that they saw the credit markets freeze up for 40 days ending in December of 2018. And I believe that's also why we're seeing QE4, not QE, being launched by the Fed. So this is something that really stands out. So I added some short exposure over here on Thursday, the 14th, the S&P 500, to add to something that I already have. And I'm a very, very patient trader. I'll go a month without trading anything. I think the last time I had a really high conviction long trade was right here. So this is after a 5-6% decline. Nobody wanted to buy the market at that point. Bought it right here and made 3.5% move on the S&P 500 in 2.5-3 days. So I would prefer that than to make 3% in 4 weeks and hold over all these red flags that show up. The fact of the matter is that the market takes the stairs up and the elevator down. These declines are usually at least 2.5 times faster and deeper than the rallies. And that's why I love trading them. You can make a lot of money really quick without a whole lot of market exposure over a long period like this when there's so many red flags out there. So let's wrap this up. Next week is going to be a holiday shortened week, only 3.5 days. So we'll be closed on Thursday for Thanksgiving, open a half a day on Friday, which starts the holiday shopping season. So what I kind of expect, I didn't add any more short exposure this week. I'm thinking about it. But what I kind of expect is that we may fill this gap up here around 31.20. And the measured move, this again, it's not quite a bear flag. It doesn't have a strong enough breakdown, but it is reflecting that same bearish price action. So you basically have about a 1% measured move on a decline. For this particular move, that's pretty much around 30.70 to 30.80. I'm kind of saying 30.75. But what a move like that would do is break this trend line definitively, right down here around 30.70 to 30.80. Next week, we'll be very busy. We have a lot of economic data. Powell speaks on Monday at 7 p.m. Brainerd speaks, Fed Brainerd at 1 p.m. on Tuesday. A lot of data, consumer confidence, GDP revisions, durable goods, CapEx, Chicago PMI, consumer spending, core inflation, beige book, and then we're closed on Thursday and half a day on Friday. I would expect that the White House wants to see this market hold up into Black Friday, the official kickoff of the holiday shopping season. So maybe I think we fill this gap, and if all those same kind of flags are here, I'll probably add to my short there and bring it up closer to my normal position size. So I hope you enjoyed the video. If you liked it, please give it a thumbs up, let other people know. And as always, if you have questions or comments, leave them in the comment section. I try to get to as many as I can. And thank you so much for watching the video. Have a fantastic rest of your weekend and a holiday week next week. Thanks for listening.